EMFR model, if price is coming back down, it did not mitigate this, it is coming in, did not mitigate, it mitigated here. So this one, price opened up here, this bearish candle. Price opened up here, took the liquidity, came all the way down and closed at this point. All right, guys, so before we even start, first questions first. How are you guys doing with the strategy itself? Do you think it's easy? You think it's difficult, or is there anything specific that you want me to cover with you guys? Any concept thereof? Yes, David.
I understand like the entry model with the taking liquidity.
Yeah.
And now, like the second entry model, which is like the battle between supply and demand. That is something that maybe I would need more explanation of.
Okay, no problem at all. So let's do that then. All right, guys. So I will just say this one more time. I mean, the whole concept of this strategy is very, very simple. What we are doing is just trying to cast a wick, and that in turn catching the ride basically in the direction trend is moving. And there is no rocket science in the entire strategy, because I've been doing this for quite some time. And over the years, what I picked up was that all the concepts, I mean, we keep saying markets are fractal constantly, but we never apply that concepts of fractalhood to lower time frames. So if, let's say, and I hear this a lot in the open trading industry, a lot of these guys do it that 4 hours is the king or 15 minutes is the king, and you should stay away from the lower time frames, the noise. Well, if lower time frames is noise, then the markets are not fractal, right? And if you're telling me the market is fractal, then every time frame behaves the same. So you cannot tell me that 4 hours is stronger or more biased, heavy than 15 minutes or 10 minutes, because if the markets are the same, they all behave the same. The only difference is that the market of the 4 hour chart will behave after 4 hours, and the speed at which the lower time frame changes 1 minute, that is something that people really maybe sometimes can't focus on the speed of change. But once you start getting used to exactly what you're trying to identify, that 1 minute time frame, in my opinion, because I've been doing this for so long, is extremely slow. And you will come to that realization yourself that when you are waiting for your trades to set up, when you're waiting for your trends to show up, and you're waiting for those entry models to show up, it's going to be crazy how slow 1 minute is. And I'm like scratching my head and I'm like rolling my head over. It's like, come on, man, let those candles move in. Which is sometimes why I go into the 15 seconds and the 10 seconds time frame as well, because things are a little faster over there. But the concept is the same. And I'm most interested in you guys is to develop the skill set. The skill set where you don't need to depend on anyone. You don't need to trust anyone on topics. You have the skill set for life. And I'm a huge proponent of this, because initial days I struggled very heavily myself in trying to make sense what works, what does not work. And finally, when it dawned on me that if everybody's saying markets are fractal and they behave exactly the same, and you remove the time frames completely from the picture. So if I remove this completely from the picture over here, and then I ask you guys to tell me what time frame this chart is, you guys can tell, right? It's exactly, it could be a day chart, it could be a 4 hour chart, it could be whatever chart, right? So for me, when anybody says 4 hours is the king, or 15 minutes is the king, or 1 day, you should always have a top-down analysis. Yes, top-down analysis is good, and this is exactly what we do as well. But you modify the strategy depending on your preferences. What time allocation you can give to the charts. How life gets you busy, and how much life gives you time to be at the charts. For example, 15 and 1 minute is perfectly fine for me. But if you are at work or you are not able to look at the charts, then maybe go down to 1 hour and 5 minutes, right? You can go down to 4 hours and 15 minutes if you want, 4 hours and 10 minutes if you want. It's just fractal nature. The only thing that I would suggest is that the lower time frame should be small enough that it allows for a trend to develop on that echoes on the 15 or the larger time frame that you're looking at. So for example, in a 15-minute chart, there are 15 1-minute candles, and that would be the minimum candles that I would suggest that you should have the gap between. So if you went to, let's say, 1 hour, 15 minutes, that won't work because there are only 4 candles in 15 minutes, and then that 1 hour will be done. That's not enough to develop that trend. But if you went 4 hours, so that's 16 candles in 15 minutes, that would be just perfectly fine. Yeah. So just trying to set the stage up here. Now, another topic I wanted to talk to you about is the reason why I moved into this fractal type of trading. When you see on YouTube or maybe any professional traders coming your way, if you come across smart money concepts, right? What the whole topic is on SMC, and they're saying that this is a perfect zone. This zone has broken a structure, and then after that structure break, basically what happens is that you have you wait for the price to come back into that zone and then move to your lower time frames. I kid you not, that really, I struggled with it, right? And the reason why I struggled with it was because I was waiting till the zone came in. And once the price did go into that zone, you switch to your lower time frames to get that confirmation bias and entry. And majority of the times the entry won't show up. So my entire session is gone, or my entire day is gone with 2 sessions. And not only that, if you had a loss in that session, then you're just waiting for the next day, and then that plays a big number on your mental health. Then you start revenge trading, and then you start trying to make your money back and all that good stuff. So all what we're doing is, and don't let anybody, in fact I shouldn't say that because obviously there are many strategies that work, but to me the way I trade and the way I've put things together is the simplest way that I can sustain this over a long time. And that is how you guys need to look at this, is if you can sustain this over a period of not a week, a month, I'm talking about 5 years, 10 years, 15 years. Can you imagine the amount of life that changes in 15 years? You have kids grow up, kids go off to university, and you're still doing exactly the same topic, right? Trading exactly the same. And in our industry, the time frame is something that we put very little value at, right? Because everybody wants to become rich overnight. They would say, yeah, I've been trading for a long, long time, maybe a month or 2 months or 3 months is their trading history. But open your horizon to 10 years, right? Open your horizon to 15 years. And essentially look at this from a perspective of running a business. Like, you are professional traders, you are setting up a brand new business, and in setting up a business, you wouldn't randomly put money in if it's a trading business and you're buying product and you're moving your product to other overseas market, you're going to do your market research, right? You're going to say, what product gives me the highest bang for the buck, which has the highest margins? Can I have inventory? Can I not have inventory? All of that will play in, and then you will have a revenue cycle. You'll have a fiscal year. You will have your expenses, income statements, and all that good stuff. Treat it exactly like this. There is absolutely no reason why you lose a trade. Let's say you went and you submitted a contract, right? And you lost that contract. Maybe you lost the fees that you need to submit to be able to be part of submitting a contract to the government, right? You lost your fees. What are you going to do now? You wait and you optimize, and then you come back and then you resubmit your bid. And in this industry, what happens is, because it is so simple and easy, right? It's just one click on the mouse, and people are just entering and gambling their money away, and they're bending their rules and their strategy. And the reason why people lose. I had a loss today. I did not even sweat. And the reason for that is because I know tomorrow I will have that many candles in my 2-hour sessions in London and that many candles in my 2-hour sessions in New York, and I will get plenty of opportunities. And last thing before I go into the entries, I cannot stress the fact of how beneficial the compounding aspect of our trading business is, which typically you do not find anywhere else in business, right? You will get annualized returns of 10%, 15%. If you're a fantastic business, and in the trading world is nowhere close to even that, right? So even the Wall Street doesn't make that much. But if you if you look at it objectively from far out, right, and you put this Excel sheet together. So let's say you have X amount of money that you want to play with, and your goal is to make that many hours per month, right? The return on your investment. And I have this post on my Discord under my mindset. Never forget the power of 6%, right? The 6R, right? Because if you make 6R on a monthly basis consistently, you double your money at the end of the year. So if in the start of the year you started trading with 10,000, 20,000, whatever, at the end of the year you will end up with 20,000 or 40,000. So if at the start of the year you started off with 100,000 with one of these prop firm challenges, let's say you pass a challenge, you do aggressive trading just to get to the challenge, because then once you pass the regulations, the rules kind of relax a bit. But if you start off with 100,000 past funded account and you make 6% month on month for 12 months, at the end of the year you will have $200,000 USD. So think on this for a minute. 6% a month is what? You have 2-hour trades 3 times, right? So you're making 2-hour, 2-hour, 2-hour. You have 4 weeks. Each week is 5 days, right? And all I'm asking you to do is to not put your money and gamble away. Wait for the most opportune prime entry setups where you have convinced yourself that this pattern, my eyes recognize, my mind recognize, I'm feeling a little tingly feeling in my tummy. I am going to enter on this one. And forget about it. If it loses, it loses. My trade today, it lost. It fulfilled everything that I've seen 100 times that has taken me to a winner in the past. Not only to 2-hour, I bow out at 2, but they've run for 10 hours and 20 and 30 hours. I mean, if I show you some of the trades, they've gone for 15 to 40 hours because my stop loss was 3 and the trend just ran, yes? So all I'm asking is just to wait, because there is no need to panic. There is no need to rush to get into an entry. There's just no need of any of that. And if you make 2-hour per week, stop even. Go next week, you make 2-hour, that's 4-hour. Third week, you make another 2-hour, stop. That's 6-hour right there. You're already done for the month. And then if you want to gamble, or if you want to see another pattern prop up on the 4th week, do it. That's your 8-hour right there. Nobody can consistently make that many hours on month, and not even I can, because the human mindset always steps up. Life happens, we miss trades, we are probably sometimes never in front of charts when we're supposed to be in front of charts. Sometimes we see it, but we just miss it, and we're like, after it plays out, right? So just trust the process, and once you have that process in mind, I'm pretty sure that you'll start recognizing these patterns. So let me share with you exactly. So this is a difficult trade. So in terms of the entry model failed reaction, what are we looking for? And the reason why we call it a failed reaction is because the zone that price is reacting from, that zone supposed to be holding, right? If it does not hold and it fails, then I call it a failed reaction. So forget the outcome of this trade that we are looking in this right now, right? So we have a giant bullish candle over here. 99 out of 100 times, in fact, 100 out of 100 times, I'll be marking a zone like this, right? And I'll be studying what's happening within that box. So oftentimes, and I see that on Discord sometimes, that people go beyond the 2 15-minute candles and go beyond and look at the price action that is happening on the third 15-minute candle with the same setup that happened in the first, or with the same bias that happened in the first 2 15 minutes. And I would advise, if you don't get an entry in the first 2 15-minute candles or the second 15-minute candle, because the first one is already printed out, then don't bother. Delete the box, start fresh, and see what the third candle is doing. Is it printing bullish? Is it printing downwards? Is it bearish, or is it printing an inside bar? And then reanalyze and restart your entire process. Don't get stuck on the first 2 candles and then run your entire session based on only these 2 candles. For me, if I did not get this entry, I would have deleted this box right away. Right, this would have been me, and then I would have waited for the third one to finish, and then start my entire bias again. Okay, so here what happens is, because I'm a supply and demand trader, and the reason why I'm supply and demand is because the market moves because of supply and demand. If there is supply, there is demand. If there is demand, there is supply. If you take any one of these out from the market, there is nothing to trade against. There is nothing to exchange. The entire world of business from generations and millennia go from the trading from right before man did not even have money and we used to use stone coins. I have to give you money to get something back. That is trading, that is exchange. And if you have an oversupply, price drops. And if you have a lot of demand, price goes up. That is how it works. And this is exactly how it works on the charts. So this is another one of my pet peeves where people, and I mean, nothing against them. If it works for them, it works for them. But let's say people are looking at Fibonacci series, right? And you're looking at all these key levels where price perfectly comes down and bounces off of them. Or they're looking at a certain double top patterns or triple tops or double bottom patterns or whatever have you. You can superimpose any pattern on top of a chart, right? Any pattern. And you can convince yourself of a bias that this pattern, if some things happen in this pattern in a certain fashion, the trade goes in my direction. And you will find ample of chances and opportunities where that works for you, but does not mean that the pattern is moving the market. The pattern has nothing to do with it. The pattern is not moving the market. The supply and demand and the exchange between buyers and sellers is moving the market, right? So when and how do you define these zones, right? So what is a supply, what is a demand, and how do you define these zones? So at the back of your mind, you should always translate that to what happens in real life, right? Let's assume you are going out to buy, 10 mangoes, right? Into the market. And you have 5 shops. Each shop has 2 or 3 mangoes. None of them have 10, right? But each shop from location you're at is further away and the price is increasing, right? So you're going from a dodgy place, local in your neighborhood, let's say, and you're going to a higher suburb where the prices are going up, or a fancy supermarket and the prices are going up. So you buy the entire amount. You go to the next shop because of the 10 mangoes that you want to buy. You buy the 2, you go to the next shop, buy 3 again, so you have 5. So you have already increased the price in that entire area because the lower price is not available anymore. Then you go to the 3rd supermarket and you buy that entire amount. So that entire area, there is no price available at the lower price point. So you're increasing the price as you go again. Same thing happens in the housing market. Excessive demand, price shoots up. So what happens when price aggressively shoots up? You have a lot of money that comes in, and basically what is happening is that you have a lot of institutional investors, banks and financial institutions that are coming in, that put a lot of money into the market, which move the market then, right? And you want to go in the direction of that movement. You don't want to trade definitely against the financial institutions because it takes hell of a lot of money, trillions sometimes in terms of dollars, billions of dollars, not trillions, billions of dollars, to even move a pip in the markets. So when you see suddenly that the banks have stepped in during New York and London and the price is shooting up, there is a lot of money that has been put in. Now banks and financial institutions, when they inject money into the market, they are not looking at key levels. They're not looking at price points. They're just not looking even at the charts. Because for them, for example, if I am Mr. Tesla and I want to open up a gigafactory in China, I need to change my US dollars to Chinese currency, right? Or Japanese yen, for example. And in order to do that, I will be I'll be putting a lot of money in USD to the American banks. They will convert that into yen for Japanese market at the local bank over there. And then you can do your business. So this entire move in the markets of money from one into the other is not happening because they want to make money in Forex. It's because they're doing business. And millions of people are doing business who are transacting across borders, and that's where money comes into the market. I mean, we are retail traders. Every bank has a financial department that does Forex, yes, but that is not the amount of money that moves these markets.